What's going on, Penny Boys and Gals? What's going on, Stock Traders? And welcome to our Penny Boys University Live. I am live here, as always, with Pookie's Revenge. How we doing, Pookie?
Hello, good morning.
Good
Day.
afternoon. I know that you're in the East Coast like I am,
Yeah,
so no excuse. It is afternoon here. And yeah, I did not say Dookie, Pat. I said Pookie, Mr. Pookie's Revenge.
he's trying to start stuff, man.
We have Pookie come on with myself every Thursday, 2 p.m. Eastern, to go over a trading topic of the week. And today, we got a fun one. We're going over LLCs to start and then going over taxes. So I see you have your
Yeah.
screen pulled up. Let's just hop right into it. We're not going to get into like the whole LLCs, for people who are entrepreneurs starting a business and all that kind of stuff. But as far as like traders go, what are some of the benefits of starting LLC, and what are the potential cons of having LLC for your trading, and what can you do with it?
So that's everything that we do should be geared towards financial responsibility, right? Risk management is part of it. Future planning is part of it. Passive income, multiple streams of revenue, blah, 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 all the good stuff, right? So having an LLC is another tool that we have that provides us with certain advantages, disadvantages, and there's also other types of companies. So anyone who doesn't know, an LLC is a limited liability company, and that's just a license that you get. You register your company through the state, and that allows you to treat yourself as a business entity rather than just an individual person. So now, when it comes to the financial realm, your assets and stuff that you pay for underneath that company belong to the company. So if you end up going bankrupt or your company gets some sort of heavy liability, you as an individual are protected in most cases because you've operated under the LLC for the business side of things. So that's kind of where the limited liability aspect comes from. So if you buy, all your computers and cars and stuff on the company name and you hit like a hardcore financial responsibility, you can't cover it, blah, 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 blah. They start taking stuff. That limitation is kind of limited to whatever belongs to the company. So they're not going to like take your house and stuff like that. So that's one of the major advantages. And obviously there are exceptions depending on what kind of liability you're taking on. Yeah, that's kind of the major advantage right there. And there's something called pass-through taxation, which is the way that they're set up by default, or you can set up as corporate taxation. So it's just a way that your taxes are filed and approached. And if you're not looking to set up a more complex business structure, in most cases, that's preferable to do an LLC rather than a corporation because they're simpler, they're easier to remain compliant, and there's just less paperwork. Now, when you start an LLC, like here in New York, for example, I have to apply to register through the state. I have to get all these papers filled out. I have to pay fees and stuff. So there's a little bit of upfront effort and cost, but it's minimal. It's a couple $100, and I have to post like 2 newspaper ads or something. And they have to run for like 72 hours. So it's really not that bad for what I get in exchange. And in return, I get an EIN so I can run an actual business. Now, if you haven't or don't prefer to trade under an LLC, you can always just keep trading as an individual. You can just do your own taxes as an individual. But if you're on an LLC, you also get a lot of tax write-off advantages. So if something, for example, I am a developer and a consultant, so I can write off a lot of my subscriptions for software. I can write off computer parts, things like that. And computers specifically have depreciation terms, so I can write them off year after year at lesser amounts, up to a certain number of years, obviously. But that's just understanding the tools that I have at my disposal given my specific circumstances. So, Patrick, yeah. So I've, it's everyone's kind of responsibility to look into their own advantages and disadvantages. But it's at least worth looking into, and that's where it's beneficial just to have a talk with a CPA or some sort of locally licensed tax professional, so they can kind of assess your situation and offer guidance on what is best for you and your specific scenario, right? And beyond LLCs, there's also C corps and S corps, and those are just different types of companies that kind of have similar parameters. There's just different tax advantages and burdens. There's different elements to the way the companies run, the compliances and stuff like that. You can also go the nonprofit route. That's pretty good. They're a little harder to get, but they're pretty good as long as you have a legitimate purpose, obviously. And anyone who's worked for a say a hospital, for example, you know how they always have like a saint, blah, blah, blah. That's so they can qualify for a 403B, which means that they can deduct your contributions to your retirement plan pre-tax, so that your overall tax burden on each check is lower because it's considered a religious institution. So they're allowed to go that route. So there's that. There's co-ops. There's other different structures and things like that, but we don't want to go too far down the rabbit hole. But it's worth looking into. It's worth the conversation.
So what type of and we're going to get into taxes in general, but for just now, what types of expenses related to stock trading can be deducted within the LLC?
Well, so it depends on how your company's set up and what you're registered under. So, for example, I'm development and consulting, so I can write off my like TradingView subscription, for example, because I write and sell an indicator on TradingView, so I can deduct that subscription. My computer, basically any software that's related to it, and as well as if you work from home, you can write off portions of your rent, your electric, your internet, your phone. In most cases, you can write off just various things, right? But the trick is it has to pertain to the business. Like you can't just write off everything because that's tax fraud. So that's really where it's going to be important to have that talk with your tax professional and make sure you just keep all the receipts just to have them, and then let them figure out which ones you can use until you are kind of up to snuff and can do it on your own. If you try to keep up with your state's tax code, it's going to be very complex, very time intensive. So why not just pay someone to do it for you that's gone to college and it's their job to keep up on that stuff till you know what you're doing.
I know you mentioned your state's code and all that. Are there specific? I know with you with trading crypto, New York has certain laws with crypto that other states don't. When it comes to LLCs, are there certain states that are more favorable for setting up an LLC or just for trading stocks in terms of tax regulations?
Absolutely, yeah. I mean, some states don't even have state tax. Like I believe Texas and Florida and maybe Tennessee. I don't remember if they. I don't believe they do. That's sales tax anyway. I'm not sure how that applies to crypto. I just know that when you get your Schedule D, there is a state component on it. So you have to just kind of look into your own state's regulations and figure it out from there. I personally don't like trading crypto in New York because there's so many obstacles for them to get registered to be able to be traded in New York. So that's kind of the challenge there. It's not so much the tax results because it's still just a bought and sold instrument.
I know, up California, New York, New Jersey, Minnesota, even, some of these have higher state income taxes, just taxes in general, as opposed to like some other, places like Wyoming, Nevada, Florida, or whatever. Is that something that people should be keeping in mind when they get into the market? Is it significant enough of a difference between like a California and a Nevada, or is it just not really, it's just pennies on the dollar?
No, it can be. So again, it all depends. And that's, I'm not using that as like a cop-out answer. It literally depends. Like if you set up an out-of-state business, for example, and you assign yourself as an employee for that, you're responsible for out-of-state taxes. And in some circumstances, that may actually be better for you than working, from within that state. So you can still own the business from living in that state. But if you set up a company in a different state, like a lot of companies set up their businesses in like Delaware and stuff because of the state laws that favor businesses. So yeah, it's absolutely worth it just to figure out what you can leverage and what really doesn't matter at the end of the day.
Nice. And just when it comes to LLCs in general, are there basically any special criteria, eligibility requirements for forming an LLC or just for trading stocks in general when it comes to like taxes and LLCs?
Yeah, every state has state-specific regulations when it comes to setting up the LLC, as well as how you file your taxes under that LLC. So again, there's pass-through, which is the default for most states for LLCs, or maybe all at this point. But you can also opt for corporate taxation, which is different. It's got a different set of rules attached to it. So it really just kind of depends on what your specific circumstances are and how you plan to benefit from it. So if you're, let's say you're brand new, right? You just set up a company and you want to set your business up as an entertainment company, for example. Your stock-related taxes are generally going to be pretty consistent all throughout, minus what you can deduct based on your business, unless your business is centered on trading and P&L and stuff like that. Now, if you want to go the extra mile and get yourself a Series 7, Series 63 and become a fiduciary and then, manage and broker other people's money and assets, that's definitely going to have an impact on how you file your taxes and how you set up your business. But if you're just kind of chilling in a basement and just trading here and there and just trying to figure it out, it's not really going to matter too much in most cases. But again, none of this is tax or financial advice. You got to have that conversation with a locally licensed tax professional that kind of knows how to work with you.
And it's safe to say that typically they is like a legal age for setting up LLC.
What's that? What was the question?
Is there typically a legal age for setting up the LLC?
I believe it's 18. I'm not sure. I would assume every state has kind of different stuff. I don't know that off the top of my head. I do know that you have to pay for it and you have to register to operate the company. So I assume you have to be 18 or have someone who's over 18 do that for you.
Right. Well, speaking of paying for, are there any, like, I know some of them have like, annual filings or fees. Do you know how that kind of works when it comes to LLCs, or is that something as like a stock trader just using it just for stock trading? They really probably wouldn't have to worry about it.
For the most part, no. So again, it really just depends. If you're a big company, like if you're, obviously we'd look at the 8Ks, the 10Ks, the 10Qs, the SEC filings. Those are different than the IRS filings that you're responsible for. But if you are big enough and you register for the SEC and you have to report those things, there are costs associated with them. Yes.
We got a question in the chat as well from Hefe. They said, so as long as I have an EIN number, I can set up a trading account in my LLC's name, correct?
Yeah, but again, the benefit of that might not be ideal. It all depends on your circumstances and how that company is structured. But yeah, in most cases, you have the option to do that as long as your broker allows it and all that good stuff.
Nice. When it comes to setting up your LLC, does it have to be in, like, how did you have to have a physical address in the state that you're setting it up, or can you, go set your LLC up in a place, like Wyoming or, somewhere else that has a better tax laws, or do you have to have a physical address there?
No, well, so yes, I believe you need a physical address, but it doesn't need to be your primary residence. In most cases, I'm not 100% sure of that, but you do need a physical address. I'm not sure if states allow PO boxes. I don't think they do, which is why also a lot of companies try to set up in like Puerto Rico and U.S. territories, because there's different sets of laws for those areas. So
yeah, no,
I would say yes.
The businesses, they're all about Puerto Rico and the taxes there.
Oh yeah.
So anyone, do you have, first of all, Pookie, do you have anything else that you want to go over before we head over from LLCs into the taxes, just in general as a topic? And also, does anyone from the chat, does anyone have any questions about LLCs? I see Hefe saying, I set the company up to strictly invest in the stock market and other small businesses. Yeah.
What was the question?
No, there was a comment.
Oh, I thought you said something before that. Yeah, so I mean, really just give this some thought, guys. It is important if you want to leverage those taxes to the best of your ability, because, we want to use everything at our disposal because our government kind of sucks, right? We're not the most efficient economy. So any edge you can have and give yourself, you're going to want to capitalize on the best way possible. Now there is a cost to that. So you don't want to go super far down the rabbit hole and become a CPA and all that stuff just so you can do your taxes effectively. But it is worth at least looking into and having that conversation. And this stuff should be part of your long-term financial plan. So if you're not thinking more than, 2 years down the road, you don't have a 5-year, 10-year, 15-year set of goals and things that you would like to accomplish, now's the time to start thinking about it, because 10 years from now, you don't want to look back and say, oh, I wish I started 10 years ago, because you can start today and then you won't have to say that 10 years from now.
So Prime Patrick has a fun question in the chat. He's asking for a friend. If you open an LLC and trade under that umbrella, are your personal assets at risk if you go into margin and get shook? If like a AMC happens or something like that, and you're on the opposite end.
So that depends on the agreement between you and your financial institution. In most cases, yes, you are as an individual responsible for margin, but it depends. I mean, you can set up an investment company, and at that point, then it would just be limited to the assets for the most part. But in most cases, you're responsible for margin, and your broker should have some. Yeah, if you just delete your app, man, it's fine. It goes away. Let's just leave it at that. I'm just kidding. For legal reasons, I can't say that. No, if you do get like hooked for margin, your broker or financial institution should resolve that. If they're unable to resolve it, they will probably just bring litigation against you. At which point you have the option to kind of advocate for yourself under your business if you want, but it's ultimately just going to be the judge's choice, and how you present that case is going to matter. So it's best not to land yourself in that situation, and just don't trade what you can't afford to trade, bud.
Prime Patrick's tried to end up sitting next to SBF, I guess, huh?
Yeah, it's a little bit of upfront legwork and a little bit of cost, but there's other opportunities besides just taxes and just setting up an LLC and just managing this and managing that. Like you can use an LLC to establish lines of credit with a bank. You can get a company credit card. You can set up bank accounts. You can take out insurance on your company and all kinds of other little tweaks. And then, depending on how serious you want to get about it, if you have those insurance policies and they're the right type and size and structure and all that good stuff, you can use those as collateral for taking out debt, which is tax-free, and you can use that for reinvestment as long as you have a solid plan in place. I don't want you guys to take out debt just because you can. But there's all kinds of cool things you can do once you learn about them. So take a genuine, active interest in your financial future, ask questions, and give yourself permission to be curious, and you'll be all right. There, you can split it up too. His home is in an S corp, and his vehicles are in an LLC.
Yeah,
that's awesome.
I love that.
That's the way to do it.
Just seeing if we have any other questions on LLCs before we head over to the next topic. Or Pookie, anything else you want to say before we go to taxes, just in general?
No, I think I've preached enough. Just take it seriously, guys. That's all. Make a plan for long term, not just for where you want your account to be in 6 months.
Brother D says, can I travel the country in an RV and write everything off for research purposes? Maybe buy one share a company in the place I'm staying.
That is an interesting question, and the answer is yes and no. So if you are traveling within the domestic U.S. and you're a U.S. citizen, I'm not sure what the minimum stay is required for an RV to be an established residence. But if you are traveling with the intent for research and that pertains to your business, you can usually write that stuff off. Meals, events, anywhere where you kind of engage or represent with your business. And in this case, if it's research, it depends on that research. If you're just saying, I want to study people's faces, anywhere you go where there's a person, you could try to write that off. But you're going to have to defend that if you get audited. So use your best judgment. And yeah, that's all. Just use your best judgment, guys. I don't want anyone to get in trouble or anything like that.
I want to see how many cars are in the parking lot at Meta. It's for fundamental analysis purposes only.
That's right. The judge is gonna be like, why didn't you just Google Maps it? No, it's legitimate. Some people set up companies just so they can put themselves through school as well. Ooh. Like that's an option, because you can take on that collateralized debt on insurance and use that to pay for your college up front. But you have to pay it back. And there's, you get to just understand the structure of things that you're trying to do and make sure you have a plan for every single scenario, just like we do with trading. And having an LLC is a form of a stop loss, basically. So that's all.
I like that analogy.
Yeah, audits suck, man. Don't ever.
For 15 years. So when it comes to capital gains tax and just how they are taxed, could you just quickly explain the difference between short-term and long-term capital gains tax?
Yeah, so a capital gains tax is a term which refers to when you sell a position that you've bought, right, in the stock market specifically. There are other types of capital gains, but for this conversation, we'll just talk about selling shares, for example, shares and options, right? So if you buy, let's say you buy one share of SPY at $400 and it goes up to $420 2 months later, then you will have $20 in realized profit, okay? And short term just means that you've sold it before the 1 year mark of when you bought it. So if you've held something for less than a year and you sell it, that is a short-term gain if it's a profit. If it's more than a year, that becomes a long-term capital gain, assuming it's a profit. and they have two different tax burdens. So short-term capital gains is typically, and again, this is not financial advice. I can't legally claim that these are accurate numbers, but for most people, short-term capital gain is taxed at a rate of about 37%, I believe. Longer term drops way, way, way down. And that's cool because there's also capital losses. And when you do your capital losses, you can claim 100% of those as long as you don't violate the wash sale rule, which we'll get into at another point. Does that satisfy your question, Doc?
No, I love that.
Trying to put me on the spot.
That's so funny. I was actually just messaged DM'd you about that. I'm like, we need to start a podcast. It's called Pookies on the Spot. Or just
there we go.
Spot about random topics.
Yeah, let's see how calm Pookie can actually stay.
So I got another fun question for you. Speaking of putting you on the spot, because I know that recently, or just the past couple of weeks, we know us in Penny Boys University, our live class, we're talking about commodity trading, forex, futures. I'm not going to ask you about all that stuff, but we also mentioned bonds, and obviously we do options trading here. How does a tax treatment differ for different types of investments, such as stocks, bonds, and options?
It depends on what type it is. Most of the time, it's pretty consistent. But it really depends. Like bonds are definitely treated differently than stock shares, for example, or ETF shares, right? In some regard. I'm not saying that the responsibility for you paying that short-term capital gains tax is different necessarily, but it depends. Like it also depends on how you're trading. If you're trading under an IRA, for example, you're going to have a different tax circumstance than if you're trading on a regular margin account. So there's a lot of factors that go into it, and that's why it's important to kind of identify your own parameters and then look into those answers with the help of someone who's locally licensed. Because I can tell you all the time, like, oh, I have this account and I pay this much and blah, blah, blah. It's not going to apply to everyone. That's the challenge here is a lot of this stuff just depends.
I know that, we're talking about auditing and liabilities and stuff. Is there any like tax strategies that people can use to minimize liabilities for active traders or just traders?
Absolutely. I'm glad you asked. Yeah. So as you can see here, I started doing a flow chart. So let's just walk through that. And before I do that, I want to just walk down to this little flow chart that I have for my consistent contributions plan. And basically that just, I'm not going to worry about the reinvestment stuff because up here, so I'll just walk through it really quick. So every month I'm going to put $500 in this new account, right? That's a contribution. It's a consistent contribution. Doesn't have to be $500, just whatever someone can afford. Let's just assume that they're using 500. And let's assume that they want to use 70% of that money for investments and reinvestments for passive growth and $150 or 30% for short-term like active trades. Okay. If you're just buying dividend shares and you're taking the dividends and using those to buy more shares, and every time you contribute, you just buy more shares, you're not selling anything. So the tax burden does not apply to those shares. It only applies to the dividends. So in this top route here, where we're just contributing and buying shares and just amassing equity, we don't necessarily have to worry about a tax burden. However, if we took that 30% and we split it up into 33% and we're just trading day after day after day after day, we're going to be racking up profits and losses left and right because that's just how active trading goes. So within that, I've allotted myself a one-time per month loss on SPX or SPY. And the reason I do that is because I can have as many wins as I want, right? Because if I win $100 on SPY and then I win another $100 on SPY and then I win another $100 on SPY, that's $300 in a row. And I'm responsible for, again, roughly 37% of that because it's a short-term capital gain since I've held them for less than a year and I'm realizing a profit. Okay. But as soon as I hit that loss, I stop trading that ticker. And the reason for that is because there's something known as the wash sale rule. And the wash sale rule was implemented, I think, back in the 90s because larger hedge funds were buying and selling repeatedly and quickly to drum up the volume on a ticker artificially to encourage other people to buy. It's a deceptive practice. But another aspect of that was that they were able to claim those losses on their taxes for those small losses because they add up so frequently. And the IRS is like, no, you need to stop doing that because it's greedy and you're stupid. So, so the wash sale rule was put in place. And what that means is that when you sell something for a loss, you can claim it on your taxes unless you re-enter a substantially similar position within 30 days. Okay. And so in this example here, if I win 3 SPY trades in a row, and then I take a loss, I'm done trading SPY. And all I have to do is just switch to another ticker. So in this case, I'm switching SPX and SPY every other month. And then that way I don't have to worry about re-entering within that 30-day period on SPY, for example, which is why I have this down here, this oscillate SPX, SPY. And what that does is it puts the entire amount of losses for the year on both those contracts into my capital losses bucket at the end of the year when I file my taxes, since I'm not re-entering, right? So I can claim them all. And that capital loss is then, whoops, where did that go? That goes into the bucket at the end of the year. And when it's time to file my taxes, I can literally claim 100% of those as a deduction. Okay. Now, again, this is just general education. Everyone's circumstance is different. If you're married versus filing single or an individual, you're going to have different numbers. So I'll walk through those too, but just make sure you guys ask a CPA if you're not sure. So basically, let's just say I take all my losses from the year, okay? And I haven't violated the wash sale rule, and I can use up to 100% of them on my taxes as deductions. The first thing that is applied to is my capital gains. So if I win $5,000 and I lose $3,000 for the year, I can take that $3,000, subtract it from the $5,000, and I'm only responsible for taxes on the $2,000 which remain at that point as gains, right? So that already knocks $3,000 off my taxes. So that's pretty cool. But I can take it a step farther, and this is what most people don't really know about, is there's not just the $3,000 for your capital gains, but you can also apply up to $3,000 for your salary and income. So if I was also working and I made $65,000 a year, I get to knock another $3,000 up to off of that salary and income, which reduces my tax burden again. So my capital gains and my salary are both reduced by up to $3,000 per year. And if, let's just say I had $20,000 in losses, this only adds up to $6,000 per year. There's something called indefinite carry forward, which means that anything I don't use carries forward to the next year, and so on and so forth, until it's all used up. Now, again, if you have unique circumstances, these numbers will not be accurate. Like if you're married and filing individually, it's $1,500, I believe. So you're going to cut that in half. But being able to apply it to both of these is an extra $6,000 that I didn't have. But more importantly, I'm recouping the value of this loss that I'm allowed to have. And I don't have to sacrifice that by re-entering the same ticker over and over and over again, because at the end of the year, not only have I hurt myself on those trades by taking those losses, but I've sacrificed them and I don't get the tax advantage. So just knowing that and being able to put it in place gives you a huge advantage over yourself, basically, because that first couple of years when you're trying to figure out how to trade, this stuff adds up, these losses. So until the profits are adding up too, you might as well get the most out of it, right? Yeah. So there's a lot. There's a lot you can know about.
No, this is good though. This is a great start.
Yeah, I don't want to get like too far down the rabbit hole, but does everyone understand that? Like, again, in just speaking generally here, it's not for everybody, but in general, when a trader realizes losses, as long as they don't re-enter those substantially similar positions, $3,000 up to $3,000 worth of those losses gets applied to their capital gains burden, and then another $3,000 up to can then be applied to their salary and income as a deduction. So let me just finish drawing those. Okay. And then on this, the capital gains, if it's short-term capital gains, that's roughly 37%. So if I have $100 in profits and $100 in losses, let's just say I traded 2 trades. I got a $100 profit, $100 loss. Now that would never happen because we use disproportionate profit to loss. But if it did, I would get the full $100 back. But I would only be paying taxes on 37% of the $100 profit, which is also false because that $100 profit would be wiped out. The tax burden on the $100 profit would be wiped out by the $100 loss. So my break even would be truly break even, except I would be able to have a profit on top of it. Does that make sense? So you get a free $100 in that case.
It's like pass and go, but So 200 is 100.
And it's all because you didn't jump back into that trade and and sacrifice that loss.
So that's another reason, not to let the FOMO get the best of you. It's also the taxes.
Yeah. So if you guys are looking for free money, it's right in front of you, even in your losses. You just have to not give them right back.
So Ivan, or do you have anything else as far as the that spreadsheet goes, or this topic, before I ask the totally curveball question for you?
No, I want this particular realization to sink in with everybody, because this is a game changer. If you're not sure how to turn your stuff around, it definitely helps. So, use every advantage you have. If you have access to a 403b, go work for them part-time. It'll reduce your tax burden at the end of the year on those wages. Make donations throughout the year, get receipts, because those can also be used as deductions for individuals. You don't need to be a company for that. Just make sure you're donating to a registered charity. That way you can get that receipt and write it off. Understand your business advantages. Your liability versus tax burden versus corporate structure, or company structure, I should say. Make sure you stay compliant, obviously. Trying to think if there's anything else, but mostly it's just this. Like, if you're losing, you're not necessarily losing. Right? I want everyone to just kind of understand that. You're only really losing if you're taking losses inconsistently. You just can't figure it out, and you're also giving those tax advantages back. Otherwise, you can get a full refund as long as you do it the right way. It might just be spread out over a couple of years if it's more than 3K. So that's all.
I know, speaking of 3 years and all that, we have these, investors out here who are looking at those long-term, 1, 2, 3 year type plays. And a lot of those investors invest in dividends and just interest income and stuff like that from stock investments. How does that work when it comes to your taxes? Like, is there anything you should be worried about, your income from dividends being taxed, and how you can plan for that?
Yeah, so dividends, gifts, all kinds of things they still carry a tax burden. And this is really where you need to talk to a tax professional, because depending on the type of gift or inheritance, for example, you may not be required to pay or the full amount. It really just depends. But your dividends do still carry a tax burden, which is important to offset those with your losses, because your dividend income shouldn't outweigh your losses in most cases. If it is, you're still making profit. But being able to offset those with deductions and stuff, and if you're not like above $1 million on your account, you should be able to offset those pretty easily with some small losses. But since you're not selling those shares, or if you are, it should be a short-term capital gains burden. Since you're not selling them and you're just racking them up, you do still have to keep track of those dividends, but that's all on your Schedule D as well. So you don't have to manually keep track of every 38-cent payment.
I'm glad you actually just brought that up, keeping track of every 30, cent payment and all that. Because I'm just curious, because I'm terrible at record keeping. I should probably get a filing cabinet. When it comes to record keeping practices for traders, what are some things that us as traders need to make sure that we do keep and keep records of and just have available when it comes to taxes and just when tax season comes?
Well, that depends on your type of trading. If you're someone who just acquire shares for dividends and you're just looking for passive growth, you don't really need to worry about much. Obviously, your consistent contributions, external activities like donations and stuff that you can deduct, those are all important. But mostly you're just going to be concerned with the dividends and stuff like that. If you do have to offload shares, like if you're in an ETF and the underlying security or whatever falls apart, you're probably going to want to sell that. Or maybe you're trading options against your holdings. That's another popular strategy. You can sell covered calls and things like that. Actually, I believe Snowflake is doing that with Ford, just to get more shares against shares he already owns. Those contracts also count. So you have to be careful about the tax burdens on those, because they're short-term capital gains. But other than that, you don't really have too much to worry about unless you're actively trading in and out, in and out, in and out. And then your Schedule D gets pretty big. So I would recommend keeping track of your dividends. But again, that's on your Schedule D. Robinhood, Webull, and most of them have pretty consistent tax documents that they make accessible to you. So just make sure you keep a copy of that. Worst case scenario, you get audited, you go in there, you show them all your stuff, they ask you a bunch of questions, and then They just kind of adjust your responsibility. If you lie or anything like that, yeah, you probably go to jail. But for the most part, it's just setting you straight. So yeah, it's if you're actively trading, you're going to want to keep track of that wash sale stuff, because if you exit a trade and enter in a bigger position and take that second loss and it's bigger than your first loss, you might forego the first one because you can't claim it anyway. But you want to make sure that you don't re-enter that same position and sacrifice the second loss as well. So it really depends on your particular strategies. If you're someone like Patrick just asked in the chat, he said, can you go over the tax implication, if any, if I choose to roll an option past expiration to either harvest loss or push gain into next year? So in that case, as soon as you lock the result of that initial contract, you are responsible for taxes on the net difference. So if it's a loss, yeah, you can claim it back. But if you re-enter a substantially similar position, such as rolling it, you probably can't. So if you roll it, you're probably going to lose that tax advantage for a wash sale. So it really just depends.
Nice. That's all I got as far as questions go. I know we're hitting that almost 40-minute mark. I want to make sure this isn't too long for those who are watching after the fact. We can stop the recording a little bit and then just hang out in the Discord if we want. But does anyone in the chat have any questions before we stop the stream?
Does anyone not have a long-term financial plan in place? Because we could teach you all this stuff, but if you don't have a plan to follow, it's not going to help you much. You're going to forget about most of the stuff when it's time to file your taxes.
I don't see any questions. Anything else from you, Pookie, before we end the recording part of the stream?
No, I think we're good. This is a nice consolidated source of information. Make sure you guys all take notes. We got the visual here on the flowchart. So just make sure you guys dig into it. If it's something that applies to your circumstances, make sure that you take the initiative and study it. Look into it. Ask us questions. Ask a CPA. Ask other people who own their companies. Just make sure that the information is filtered through the parameters of your individual circumstances. That's the most important part.
Yeah, and speaking of studying, we're currently in week 6 of our Penny Boys University 8-week curriculum. So if you haven't already, be sure to check out our premium classes channel. I just posted it in the lounge chat, and you can go ahead. The test is right there. Was the first thing you'll see if you go ahead and take that. Get degrees, and you can become just like Duco, who's putting Harsh in the chat, and be a Penny Boys University alumni. Get access to our advanced classes done by Pookie's Revenge and Swinging Bowls. So definitely be sure to check that out. We have another stream coming up at 5 p.m. Eastern. That's with myself and Jay. It'll be available to all premium members. I know it says alumni. For this one in particular, we'll be doing it here in the lounge. And Duco got his shirt for his graduation. Yeah, Duco,
nice.
That's awesome. Duco,
the comfy one.
A member of the term, so a student of the term, and they want a T-shirt. We are doing some more giveaways for the next graduation as well, including merch. So definitely be sure to take that test, and you can maybe become the valedictorian or student of the month, student of the term, and like Duco, get an awesome T-shirt as a prize. But yeah, 5 p.m. Eastern, we have a premium live stream with myself and BTCJ going over charting. It's going to be like an intro to our charting masterclass starting October 19th, every Thursday, 5 p.m. Eastern, instead of our normally scheduled PBU live stream. We're going to be doing a scheduled or a pre-scheduled 8-week course. So week 1 starts on the 19th, and it's going to be going over all things charting. It's basically a charting 101 masterclass going over all the things we go over in our Penny Boys University 8-week course, but just in much greater detail since we have 8 weeks to do it. So 1 week will be completely dedicated towards supply and demand. One will be support and resistance. One could be Fibonacci, and so on and so forth. And definitely, Duco, try on that merch and definitely post it so we can see.
Yeah. Did he get one of the comfy ones?
Which one's that?
The one that you hate is not the comfy one, so it's the other one.
Well, no, the one that I personally, I haven't tried it, but my girlfriend said it wasn't comfy. It was one of the I think it was the
oh, you gotta get rid of her then.
I forget which one it is. But we had a bunch of other ones that were really comfy. The Reformed Legion one's really good. The Eat Sleep Trade one is really good. And all the hoodies are comfortable. The hoodies run a little bit small though.
I do like the hoodies. Yeah, my arms are long. That's a problem. But the hoodie still fits. It's just my
Yeah.
personal preference because I use my arms over my shoulders a lot. So it pulls
Oh,
back on the wrists.
gotcha. I was like, I like think I like
Yeah,
visualize that.
YOLO.
All right, but thank you all for tuning in to. I'm just about to end the recording. Thank you all for tuning in. We will see you hopefully next stream. If not, then we'll see you next time. And until then, hope that you all make some bread.
Bye.